K. Knowledge of general financial concepts and common financial formulas, for example, time value, opportunity costs, debt structures and covenants, earnings per share, EPS, cost of capital, etc. They need knowledge of general financial concepts and common financial formulas because FP&A professionals rely on these principles to evaluate investments, support strategic decisions, and assess organizational performance. Financial concepts provide the analytical foundation for budgeting, forecasting, valuation, capital allocation, and risk management activities. Finance professionals regularly apply formulas related to time value of money, earnings per share, cost of capital, leverage, and profitability to interpret financial information and support management decisions. These concepts help organizations evaluate investment opportunities, measure financial performance, and optimize financing structures. Strong understanding of financial formulas improves forecasting accuracy, strengthens analytical capabilities, and supports long-term value creation in dynamic business environments. The time value of money, TVM, is one of the most fundamental concepts in finance because it recognizes that money received today is worth more than the same amount received in the future. This principle exists because current funds can be invested to generate returns over time. TVM forms the basis for present value, future value, discounting, annuity, and capital budgeting calculations. Common formulas include future value, where present cash flows are compounded over time, and present value, where future cash flows are discounted to today's value. Finance professionals use these calculations to evaluate investments, loans, leases, and business projects. TVM also supports net present value and discounted cash flow analysis. Opportunity cost is another essential financial concept because organizations must choose between competing uses of limited resources. Opportunity cost represents the value of the next best alternative that is sacrificed when a decision is made. In finance, investment decisions are evaluated not only on expected returns, but also on the returns foregone from alternative investments. FP&A professionals incorporate opportunity costs into capital budgeting, resource allocation, and strategic planning analyses. Understanding opportunity cost improves decision quality by ensuring management considers both explicit and implicit trade-offs. This concept also relates closely to required rates of return and cost of capital because investors expect compensation for choosing one investment over another with comparable risk characteristics. Debt structures and debt covenants are important financial concepts because organizations frequently use borrowed capital to finance operations, investments, and growth initiatives. Debt structures may include short-term loans, long-term bonds, revolving credit facilities, or hybrid financing arrangements. Debt agreements often contain covenants, which are contractual conditions imposed by lenders to protect against excessive financial risk. Common covenants may require organizations to maintain minimum liquidity levels, debt service coverage ratios, or leverage ratios. Violating covenants can result in penalties, refinancing challenges, or accelerated repayment obligations. FP&A professionals monitor debt obligations carefully because financing structures directly affect liquidity management, interest expense forecasting, financial flexibility, and long-term strategic planning decisions within organizations. Earnings per share, EPS, is a widely used profitability metric that measures the portion of a company's net income allocated to each outstanding common share. Investors and analysts frequently use EPS to evaluate profitability, compare companies, and assess financial performance trends. Basic EPS is calculated by dividing net income available to common shareholders by the weighted average number of common shares outstanding during the reporting period. Diluted EPS additionally considers the potential impact of convertible securities, stock options, and warrants. Higher EPS often indicates stronger profitability and shareholder value creation, although interpretation should consider industry conditions and accounting adjustments. EPS analysis supports valuation, investment analysis, and executive performance evaluation activities. Cost of capital represents the required return investors and lenders expect in exchange for providing capital to an organization. It serves as a critical benchmark for evaluating investment opportunities and financing decisions. Organizations typically calculate a weighted average cost of capital, WACC, which combines the costs of debt and equity financing according to their proportion within the capital structure. Higher risk investments generally require higher expected returns and therefore higher discount rates. FP&A professionals use WACC and discounted cash flow analysis, valuation models, and capital budgeting decisions to determine whether investments create shareholder value. Accurate estimation of cost of capital improves strategic planning, resource allocation, and long-term financial management effectiveness. Leverage is another critical financial concept because it measures the extent to which organizations use debt financing to support operations and growth. Financial leverage can amplify returns when investments generate profits exceeding borrowing costs, but excessive leverage also increases financial risk and earnings volatility. FP&A professionals analyze leverage ratios such as debt to equity and interest coverage ratios to evaluate financial stability and borrowing capacity. Operating leverage is also important because fixed operating costs can magnify changes in profitability when revenue fluctuates. Understanding leverage enables organizations to balance growth objectives with financial flexibility and risk management considerations. Effective leverage management supports sustainable capital structures, liquidity preservation, and long-term organizational resilience during changing economic conditions.